Morning all.
Hi Tony, good to see you.
Tony, if you'd like to hide yourself for now, my name's Charlie, we'll broadcast shortly.
Sure, have to.
Well, welcome everybody to this 45-minute webinar, which 39 Essex Chambers are putting on cyber insurance risks and cover. We are delighted to report that some 200 participants or so have joined us, both from UK, Hong Kong, Malaysia, and the Middle East. Thank you very much indeed for taking time out of your days and evenings. We, as usual, would welcome any questions at the end via the chat function. We'll do our best to meet those questions. And if we can't meet those questions, we'll try and drop you a line in due course. This webinar is being recorded. It's available on the 39 Essex Chambers site, and you're very welcome indeed to log on and pick up anything that you've missed during the course of the days after, probably Tuesday of next week. Now, we have with us Tony Richards. I'm going to give you a very brief introduction to everybody. My name is Jonathan Bellamy. I have an insurance practice which covers both policyholders and insurers. It covers all the usual issues of coverage, construction, fair presentation of risk, fraud. I do a lot of work in the financial lines and professional indemnity insurance field, including trade credit, political risks, and of course, cyber. I have experience in international insurance and reinsurance and under civil laws, and I'm a chartered arbitrator, and I sit in insurance disputes in that capacity. David Hopkins from 39 Essex Chambers is a busy commercial, regulatory and public lawyer. He has a thriving insurance practice in which he also acts for both policyholders and insurers. He brings a strong head for figures to his work, he tells me, and has had a former career as a financial derivatives structurer. He also has a hobbyist's interests, again, he tells me, in all things cyber, which started whilst at primary school on a BBC microcomputer, which he assures me must now be obsolete. And I noticed Tony laughing as I expressed that. Tony Richards, our guest speaker, we're delighted that he's been able to join us. He's a very busy man. He's a technical director of Ernst & Young, EY, technology consulting cyber practice. And he leads EY's UK architecture, engineering and emerging technology competency. He's an experienced security strategist and architect. And interestingly, he's a former Group Chief Information Security Officer. He has over 18 years experience in government, commercial and digital data security. He has had various responsibilities during his career, he tells me, one of which is being responsible for information security, not only for the UK Youth Justice Board, but also for the Supreme Court, which would mean that he's dealt with lawyers of a very high level indeed. So, with those introductions, I'm going to turn, excuse me, to the first of our bullet points for discussion. There won't be any slides. This is intended to be a roundtable style discussion, bringing in some genuine market experience. So I'm going to talk first about the scope of cyber insurance covers. We think it's useful for everyone to have a really quite a firm grip on some basic legal concepts here of first-party liability and third-party liability. It's right to say that cyber, excuse me, cyber is now not only a legal risk, it's not even an IT risk, it's an enterprise risk. And one of the biggest issues which companies of all sizes, including in particular SMEs, have had is uncertainty and inadequate cyber insurance cover. There's a common response which is, well, I'm insured, but what does that mean? What about the sublimits? What about the exclusions? What about the definitions and triggers for policy cover? All of which are matters on which we're asked to advise. This also impacts brokers and fact finds, which brokers are obliged to do before placing policies on behalf of their insured. What is their business? And how do I ensure that I get the right form of cover? So first, third-party risks and first-party risks. David, first-party risk are going to depend often on damage, which is a problem issue in cyber cover. What about third-party risk, consequential liabilities? What do you wish to say about that, and where's cyber going?
Well, it's obviously a risk which now is touched on or affects almost all businesses, much in a similar way to the data risks that businesses have. And obviously everyone got very exercised in the last 3 years over GDPR and such, and things like data breaches. What I would want to say straightforwardly is that for most policyholders who perhaps expect their policy to be covering such risks, they really need to think closely and examine closely where the cyber risks market has moved over the last few years. Obviously, GDPR was a catalyst in terms of data losses, but as well as that, there's been significant moves, especially from Lloyds and the LMA, to further define the scope of policies. That all arises, obviously, from the regulatory side, where the PRA and Bank of England have taken really quite a sensible, certainly, move, but a move which perhaps hasn't the legal effects of which haven't yet been fully threshed out. They haven't reached court, for example, on some of the most common exclusions and so on. In terms of the consequential losses, we obviously know as lawyers that we typically see policies excluding such risks and damage. But in the case of cyber, where you have non-affirmative cover, this becomes perhaps a bit of a tangled web. So really, I suppose where I'm coming from on this angle is that there is no one answer to the question, and typically it will require people to really get down into the detail and to ensure where they're advising a company in terms of what their policy should contain, that it does address potential risks that may be faced by the business, and it may well require getting some real market expertise in terms of thinking about how cyber might affect a business where it hadn't been anticipated it would. It's not a risk that simply affects IT companies, as we all know now. It could be from across any sector, So I suppose my main point is around the fact that it's extensive. The risk only grows as we go year to year, given the increased nature of use of technology and so forth. And it's something that is a, obviously highly important topic for everyone.
Dave, thanks. Before we bring in Tony on this, one of the points that I come across in practice is, as I've said before, this problem often of proving damage, particularly under non-specific policies, which are not dedicated cyber, in respect of first-party losses. The second is the scope of consequential losses and all the issues which arise from a claims-made policy, on which terms this area of sector of cover is normally written. I mean, for example, I've got one at the moment in which my own client is claiming that it's unable to comply with the disclosure obligation in a commercial action because it's been the victim of a ransomware attack. And it's inevitably going to impact their prospects of success on that, the ability to access their documents. Now, if their position in that action is prejudiced, if they're required to settle it, if extra legal fees are incurred as a result of that, is that a recoverable head of loss? And on the basis, is there a failure to mitigate to pay the ransom? Bitcoin, etc. Very interesting stuff. Tony, on the market perspective here, what's your experience and thoughts about first-party risk, the policyholder himself, and also potential liabilities and third parties?
Well, at the moment, the industry is very much geared up to, when they pay out on an insurance claim, is generally geared around some sort of incident response factor. So that's around bringing in a team to deal with the immediate issues at hand. So if that's ransomware, that's stopping it, clearing it up, or even potentially dealing with some of the fallout. So bringing in an external crisis management team or similar other actions. Generally, the policies are not covering sort of remedial action, as you might expect. Better technologies or better controls to stop further attacks. It's all very sort of short-termist and just to deal with the immediate fallout. Now, that also covers things like sort of PR and other aspects, but I haven't yet actually seen it where it's may deal with, like you say, with that situations like with your client where there's that sort of the further ripple effect of this, of the occurrence and the incident where they may have liabilities in other areas. I haven't yet seen that unfold in the industry yet, largely because I think the industry is, and certainly this aspect of it is so young. I don't think certainly the insurance companies haven't seen all these different scenarios like you would expect in, say, automotive or property insurance, and therefore not only from the aspect of the different scenarios of how these things occur and the rates of occurrence and the actuarial data that would support that, but also the situations, like you say, with third party and other liabilities.
I mean, one of the problems here, Tony, isn't it, is how reticent companies are, particularly professional services firms like lawyers, to disclose even, well, to very many people at all about the incidence of the risk. It has serious reputational effect. There are obviously regulatory obligations, which we'll come to in due course. But this is causing a problem, isn't it, with developing underwriting actuarial evidence. Is that right, Tony?
Absolutely. Even in our own work. So with Ernst Young, we have crisis management teams, and we are called in by clients. But I can tell you now, they are under strict confidentiality clauses. We can't even talk about those clients' names. It's all under project name, sort of code names and stuff like that. So yeah, absolutely. Even from our side, where we're helping clients, and there's strict secrecy around it. And like I say, we're quite used to having teams suddenly disappearing off on project Thoughtful or Project Table, or whatever the project name is, who disappear for like a couple of weeks and then come back again, but still can't talk about what they're doing.
No, well, the reputational fallout is serious, and whether it can ever be covered by any cyber insurance clause is a very interesting matter. Shall we move on and talk about the dreaded silent cyber and what's been happening in the market since then? Our listeners and viewers will be very aware of the changes that have been driven by Lloyds in the last 18 months or so, 2 years. Phase 1, Phase 2, Phase 3, culminating in, as effect from the 1st of January, the requirement from Lloyds for PII and other policies to state clearly, expressly, whether there's cover for cyber by endorsement or exclusion of cyber by exclusion. Now, David, I was going to ask you for your thoughts at this particular point. What about the regulatory aspects of this? How does the history of the regulatory response, how's that fed into, for example, the definition of cyber risk, which Lloyds are using, which I know a lot of people are very unhappy about?
Yes, absolutely. This is what I was alluding to earlier. Now, the PRA and Bank of England obviously have approached these things in terms of prudential risks. PRA, obviously, as everyone knows, coming out of the financial crisis, is taking a look at macro systemic risk to the markets in a way which wasn't perhaps previously focused on when it was all under the head of the FCA. Now, the genesis of all of this is way back, 5 years ago, certainly, the Bank of England was writing to insurers and pointing out the potential for silent cyber underwriting risk that was in their policies. Insurers have been writing policies for years which were covering cyber, perhaps unknown to them. Now, the point comes from the Bank of England and PRA. They're thinking about financial risk. They're thinking about solvency of the firms. They're not trying in any way at all to suggest to insurers that a definition of cyber underwriting risk is the same as would be defined in a policy, as in what a cyber risk is for a business. So what we've seen is, first of all, PRA writing Dear CEO letters to the insurers, getting responses from them, publishing a supervisory statement in 2017, which referred to a definition of cyber underwriting risk. And I'll just give that quickly, which the PRA defined cyber underwriting risk as the set of prudential risks emanating from underwriting insurance contracts that are exposed to cyber-related losses resulting from malicious acts and non-malicious acts involving both tangible and intangible assets. That definition has then found its way towards Lloyds, and Lloyds in a market bulletin from 2019 referred to a definition of cyber as much the same thing. Where I think perhaps some confusion is arising there is the PRA's purposes are for firms to ensure they're solvent and for firms to ensure they've calculated and priced risk appropriately. We've already talked about the fact there's limited actuarial data and so on. The PRA and Bank of England weren't trying to write a definition of cyber risk, meaning risks that are actually faced by businesses and risks which policies should necessarily respond to. So where that definition has found its way towards exclusions and inclusion clauses in policies, there is probably quite a fertile ground for lawyers to get involved when there's a question of whether or not the policy responds. And that's, I wouldn't put the blame there on PRA and Bank of England necessarily. They were doing their job from one side, and now it's found its way into perhaps a slightly different area where it's not necessarily strictly appropriate.
Yeah, well, on that, 5258, the Lloyds Bulletin, has resulted obviously in the changes that we've seen in the market, I'd say particularly from the 1st of January. What's interesting to me is how is the response. I mean, perhaps it's predictable. Perhaps the response was always going to be exclusion, not endorsement. The words of the couple of the LMA clauses, 5471 and 5477, the latter being for financial institutions, focuses on the twin concepts of cyber act and cyber incident. And when you mentioned about lawyers being involved, there's an area. When is a cyber matter a risk? The cause of a cyber act, which at the moment is defined as a malicious act, or a more general cyber incident. Tony, from the market perspective here, what have you seen? How have you appraised the developments that have happened since the moves towards more bespoke cyber policies?
There's been a mixture. So, I mean, over in the US, cyber has always been a separate or combined piece of insurance policies, normally an element with its own right. Here, it's very much at the moment they seem to be a separate piece. You either have your standard policies with cyber excluded, and then you have a top up with a specific cyber insurance. I think there's a move, like you say, at the moment, what we've seen so far is that it's generally excluded unless you happen to add it on as a sort of bolt-on, which some of the companies, the insurance companies, are now doing, so you can get your usual
at an additional premium.
Of course,
which of course is it's a wonderful example of the law of unintended consequences, really, isn't it? But that's what happens when lawyers get hold of new rules.
I mean, there is a government scheme called Cyber Essentials where you can now get, especially for small to medium companies, you can get free cyber assurance if you successfully pass that up to a certain limitation.
Because it is a feature, isn't it, of the sector distribution that SMEs have been perceived as particularly at risk and particularly badly protected in IT terms.
For sure. I mean, you think about it from everything from a one-man band up to quite, large, medium companies. It hasn't, to date, the general sort of consensus from those organisations has been that it's somebody else's problem. It doesn't happen to us. Who would want to attack whatever type of industry they are? But what we're seeing is actually there's an increase both from attacks just that are not necessarily targeted at those industries or those types of organizations, but just happen to be fallout. So ransomware, for example, is done through a shotgun effect where they're just trying to hoover up whoever they can. But also where small organizations or small to medium organizations are part of the supply chain of bigger organizations. The attackers may suffer, may not be able to get anywhere with the larger organization. Therefore, they will then target the smaller organizations as part of the supply chain to try and work their way through that route. But now,
well, at the end, one of the points we'd like, if we've got time to talk about, is omissions in cover. And it's a really interesting point about supply chains. Tony, we want to bring you in a bit more on vulnerable sectors and current cyber risks and threats. This is right up your street. Would you be so good as just to help the audience a little with the work you did as a security information officer and the sort of risks that you've seen developing? If you can talk about the Supreme Court, all the more interesting. If not, logistics, transport, shipping, and the like.
Well, interestingly enough, all sectors to some degree have the risk. Like I said, with things like ransomware, it's non-discriminatory. It's generally not targeted. It's just the attackers are firing it out as willy-nilly, just trying to see who they can get to hoover in, and therefore it really is not targeted. Other sectors are specifically targeted by, well, certainly whenever it comes to a PR release, a significant and either nation state or sophisticated criminals. I think that may be just the PR aspects rather than the reality. But even recently, over the last month, there's a major retail chain, have recently publicised about the fact that they had a major breach in January this year, where attackers were able to get in and access personal data. There was a football club, although they weren't attackers, but they still had a cyber issue in that their website allowed people to see the personal data of other members of the club and the paying patrons. So both of these are, one's an attacker-led cyber incident. The other one's a badly configured internet-based application, but they're still effectively both cyber attacks, cyber incidents rather than just attacks.
Yeah, I mean, one
so
of the. Sorry, I'm so sorry. You go ahead.
I was just going to say, so it doesn't necessarily always involve an attacker. It can just involve badly built or badly configured IT.
Something that occurs to me, Tony, which I think you are able to sort of assist us with and tell us more about, is where these attacks do happen, what's the way in which you might ascribe them to a certain individual or a certain actor? I'm thinking particularly where insurers potentially, who knows in the future certainly, may be looking to enforce their subrogated rights where there's been an attack. How easy is it? Is it possible? What kind of evidence can you generate as a security professional in terms of ascribing an attack to a particular actor?
So generally, it's actually very hard to do attribution cyber attacks when there's an attacker involved, because of the nature, that they could be from other countries, especially in jurisdictions that we don't have any access to. There are certain, especially if it's the average organisation is almost impossible. Where the government's involved, they do have more levers to pull to try and identify where the attacks come from. It's because they can work with internet service providers, telecommunications providers to trace back where the attacks came from. But ultimately, as soon as it crosses into a jurisdiction where we have no means of treaty or otherwise, you can't trace any further. Normally, when you hear in the news or in other publications about it being attributed to an organisation, or generally to China or the North Koreans or somewhere similar, it's not because they've actually attributed it back through identifying it specifically. What they've done is they've identified coding specifics, almost like sort of handwriting signature, signature sort of handwriting within the code that's been developed, or within the MO of the attack, and they sort of say, well, we've seen numerous attacks using this sort of code style or this particular method of operation, and therefore we attribute it to this group who we've seen do it numerous times. This is why they always give them sort of code names like Fancy Bear or Leaping Tiger, etc. It's because they can't specifically say, oh, it's that person. They can just go, we think it's this. We've seen several types. It's this type of group. Similar-wise, within the coding structures, obviously, if there's acrylic writing, it's the Russians. If there's Mandarin or other types of coding styles, then it could be attributed. But it's all, I'm going to be honest here, it's all a little bit sort of guesswork. It's not absolutely sort of defined or attributed it specifically. Sometimes it is. Some say, for example, and it's not where it's generally where it's a single actor or one or two actors, they may be able to attribute it back, especially if it's within jurisdictional space. Hence the two attackers who attacked TalkTalk were able to be prosecuted. And similarly for the attacker who accessed the Capital One data, again, because it was a single person or a very small group, and they were within jurisdictions, they were able to attribute it. When it comes to the larger criminal enterprises or nation state enterprises, they tend to do it from either via jurisdictions or from jurisdictions that we don't have access to. And therefore, you have to rely on these other methods, like so, almost like handwriting styles, to try and attribute it to a group.
Can I raise a question which I suspect will interest quite a few of our listeners and viewers, and that's professional services firms. There are a number of, obviously, partners whose practices are insurance practices, but also involved in risk management. Tony, my understanding, it's obviously very prevalent. I've seen it under PII policies. The stats are, I think, that in 2020, there was something like a 50% increase in ransomware attacks, which seemed to be the preferred means. this is often, isn't it, about not the information of the professional services firm itself, but about its address book, if you like, about its clients, its financial information held by clients and contact details. Is that something you've seen at EY? And what can you do? What can a solicitor's firm or an accountancy firm do as a matter of risk management and technical investment to minimize this risk?
So you get two types of attack really there. So one is the ransomware attack, where they literally, all they're interested in is getting some money, and they're just basically, you know, getting the encryption in there, and they want money to unencrypt it. Pure and simple. And this is, to be honest, the North Koreans do this a lot as a way of raising dollar value. The other attacks, as you say, are, you know, more targeted and maybe around a specific reason. And they generally don't use ransomware. They'll be using other mechanisms to get in there and to exfiltrate as much data as possible. And then they then have two opportunities there after they've exfiltrated the data, either to sell it on to other organizations, criminal organizations, or to sell it back to the organization they've stolen it from. And even then, there has been an uptick of a dual attack, where they've effectively, what they've done is they've exfiltrated the data and then dropped the ransomware, the encryption ransomware. So then they initially will ask for money for to decrypt the ransomware, and then may either further sell the information they've extracted, or again approach for more money to sell back the data. And in that situation, you just don't know if you're going to get back the data, or if they, you know, you do get it back, but they've also got a copy which they'll sell on again. So, you know, they're really quite, you know, these mechanisms of raising, ultimately they all boil down to money, and raising money through, you know, untraceable means such as Bitcoin. They're just getting more, like I say, straight up. There's just some groups are getting more technical and more sort of clever with how they do it, you know, through not just doing the standard ransomware, but doing these multi-stage attacks to sort of maximize their income.
One of the sorry, yeah, David, what are your thoughts on this?
Well, it's not a huge point, as it potentially is a huge point, but it's not a long point. It's simply that raising it in terms of the professional services firms, going back as well to, you know, your third-party risks. As you said, Jonathan, that's really often going to be about address book and stuff like that. Now, quantifying what your exposure is in that scenario to a cyber attack, the numbers become quite boggling potentially. When you look at perhaps your own individual risk as the first party, as a professional services firm, as you suggest, Jonathan, is not limited, and it might simply be that someone's coming after you for some ransomware to encrypt your data, ask you for a payment, and they get the payment or they don't get the payment. But if there's then consequential losses as a result of having access to that address book and so on, you know, professional services firms, given their address books, that becomes something where it's much more difficult to appreciate the risk in advance. And I don't know, Tony, whether that's an area you get involved in your own work, in terms of trying to put a handle on what a company's exposure is potentially.
Yeah, we do quite often, and it's what one of our central services, as it were, is conducting cyber assessments to see what the maturity of the organization's cyber security is like, and then to give recommendations on where, you know, if there's any deficiencies or areas that require enhancement or improvement, you know, what can be done to raise that up to, you know, industry best practice. I mean, the general, with regard to, you know, those sort of ransomware type attacks, your main areas of sort of mitigating that, you know, are ensuring that you've got encryption on the databases, or, you know, or file stores where you've got your client's information. So that's, if it is extracted, it's encrypted, and therefore the attacker themselves can't access it. But also to have logically unconnected backups. So the data itself is regularly backed up into a system that is either disconnected or logically separated from your main IT systems. So therefore, if you do get ransomware and it encrypts your main systems, you've got clean copies that you can recover from, so you don't have to pay a ransomware.
And you have something approaching an air gap which permits you to continue. I mean, reputational loss, which you just touched on, Tony, we've touched on already during this presentation, extremely important, really is. One of the questions we've had in neatly links with this point, and that's inviting comments about the insurability as a legal point, about the public policy aspect of paying ransomwares, and also GDPR fines. This is something on which I've certainly advised from time to time. Many policies include a wording which certainly so far as fines provide, typical wording is insofar as they are insurable. Now, legal systems do differ on this, and I've had cause to compare legal systems, common law systems with some civil law systems as well. Generally speaking, the English common law will not permit the insurability of a fine, a true fine, where it is premised on any degree of moral fault. Where there is a strict liability sanction is as yet undecided. First instance is going to say to you, not insurable, but I think that given what we know with the various Google litigation, the increasing prevalence of group claims, and the tort remedies which the appellate courts are now permitting, I think this is going to be an area that's going to be tested. On ransom payments, I don't see a reason why they're not enforceable. Yes, they are paid to, if you like, bad actors, but they are the way, aren't they, the most effective way of an insured mitigating its loss and arguably complying with its duties to cooperate under the policy. Where it is important to recognise, rather like certain other forms of kidnap and other genuine ransom insurance, is to bring in the insurer. You're not going to be able to claim this sum unless you've had it approved by the insurer. So that's something that needs to be thought about from a policyholder's perspective. Whether you have to pay in Bitcoin or dollars, not sure it logically makes a difference. But I'm more persuaded myself on ransom payments than GDR fines. Tony, I was just going to bring in transport and shipping and logistics generally. Now, we're aware of the various problems that Merck had and the incidents of piracy caused by malicious software code, particularly around some coasts in Asia, which are causing collisions and delays and ransom. What's been your experience of where the real risks are for those advising people in the transport sectors?
Well, we've certainly seen an uptick. Well, over the last couple of years, there's definitely been some big attacks, and we've definitely seen an uptick in international transport companies and specifically shipping organisations seeking to increase, or certainly to review and then increase their cybersecurity, not just on their organisation, but actually, interestingly enough, on those shipping systems. Previously, the IT equipment on ships, which has been growing, exponentially as more and more, systems are digitised. Suddenly they've realised that there's been absolutely no security around these systems, and therefore there's suddenly now an uptick of interest in that following a lot of these sort of incidents, both from direct attacks, but also even just for again, ransomware could take out an entire ship if it gets on lead by accident. So there's definitely been a renewed interest, and over the last, I'd say, 24 months, with more and more work being involved in that.
Just we're coming towards the end of our time. Before any further questions, I've got a couple that I'll bring in. One of the questions, which I'm very happy to share with David, his observations, comes from Asia. What are the key risks for a board of directors of a company that suffer a cyber risk, as well as the payment of a ransom? This could play into D&O cover, or it could just be the sort of steps that the directors should take to remediate as soon as possible, inform their clients. David, any observations on this one?
Well, no, absolutely, Jonathan. You're right. The it goes without saying the overriding responsibility here is for the directors to act in the best interest of the company. Now, this can get tricky, especially in areas where there may be a what's the word I'm looking for? An expedient solution to the problem, which involves directors potentially doing things personally, and the difficulties may well arise where they act in a way which certainly is to the benefit of the company, but may well then not fall within the scope of their D&O cover. What I would be advising is certainly a director not to make any personal payments of ransom, for example. What the most likely outcome in such a scenario would be is that if the policy does respond, if the policy does give coverage for ransom, is to take it up with the insurer and not to perhaps take some measures which might be expedient, but which may well result in falling outside of the scope of cover and then therefore not being able to get any kind of indemnity as a result.
Yeah, here's an interesting one, and it's probably for Tony, like most of the interesting ones are in this sector. It's a question about the use of what's described as vetted ethical hackers. If you like, poachers turned gamekeeper. What value is it to use these individuals, as I'm aware certain professional services and other firms use, to, if you like, stress test the system? And does it work, Tony? Is it a good idea to use these individuals? Does it work? Or does it just provide so-called ethical hackers with the ability to be less ethical in a year's time?
No, it definitely works. We have our own ethical hackers and pen testing teams as well, like many of the professional services firms do. No, absolutely. Effectively, what they're doing is they act as if they were an external attacker. They attempt to penetrate or to gain access to systems and services, and then they provide a report indicating any areas where you're weak. Now, obviously, as you might expect across the industry, there's variations of quality, but ultimately, no, it's definitely worth doing, even if it's just to test your external points of entry, just to make sure that people can't get in. So definitely, maybe not so much just ordinary poster sign websites, but if you have any form of sort of login applications or services like that on the internet, it's definitely advisable to have them tested. At least when you stand them up, if not sort of annually, depending on how much technologies change or improve. Because any system that has customer data or personal information on it should definitely be tested. To make sure that these things happen. TalkTalk was a prime example where, and so Equifax as well, where there are vulnerabilities in their online systems, and in both those cases they'd actually had it pen tested, they just hadn't done anything about it. So yeah, it's not just a case of getting them tested, it's you then, please act on the recommendations that the pen testers make, so that, if they could find a hole, then attackers out there can find a hole too.
Yeah, and Microsoft and other firms use this, don't they, to check out patches and things on their own products. It's not just enterprises subject to cyber insurance, is it?
Oh no, everybody should.
Sorry, no, go ahead, Tony.
I was just saying, absolutely. If you're developing systems, then you should get them tested before you go live, or certainly at least, if you've already gone live, it's worth getting them tested anyway, just to find out if there are any incidents. Do they need updated patches? Are there any issues like cross-site scripting or SQL injections, etc.? These are all sort of weaknesses that attackers can leave, even down to what we call input validation, where an attacker can inject computer code into a text box, for example, if the text box isn't validating what's being inputted, then that code could actually then trigger the internal systems to provide information such as passwords and usernames, etc.
There was a recent example of that with Companies House. I think someone named a company with a line of code, which caused some issues at Companies House. Leading on from that, I've actually got a question for Jonathan, where someone has taken those kinds of actions to validate their security and so on, either of their own volition or perhaps at the request of an insurer or as part of the terms of their policy. Jonathan, where do you see issues arising perhaps for someone, as Tony suggests, who maybe doesn't fully implement recommendations and so on?
Well, the obvious, it's an important question. The obvious point there is whether there's a breach of conditional warranty in the policy from a lawyer's perspective. This is to be worked through because there's no case law yet on this sort of breach in the context of a cyber insurance policy. But the policy needs to be read carefully. How often has one said that? We've had a very interesting question come in, which we're not going to have time to deal with fully, but about words like direct and indirect in the RUA exclusion. This, as the questioner rightly says, what is going to be the attitude of the senior appellate courts to exclusions? Look at what happened in the Supreme Court in business interruption insurance, something I've spent a lot of time dealing with in the last year or so, about taking away the core of the policy. The courts are not, by the look of it, going to let that happen. This leads us on really to some omissions. I mean, what about system failure? This is a big problem that's not caused by an external cyber incident. Is that covered? Cyber losses caused by outsourced service providers, which affect a business. Is that a business interruption claim rather than a cyber claim? And if so, will the policy, business interruption policy, if you have a non-damage policy, respond? What about loss generally caused to your company in the supply chain? And finally, all the problems that happen with retroactive cover. As I said, these policies are normally written on a claims-made basis. There's often a important lag of time between what might be described as the event and the loss taking place. And one of the needs of companies and brokers is to ensure that there should be a retroactive cover in place. Tony, I'm going to give you the last word on this because we've had a few more questions, but we're not going to have time to answer them. Conscious we're in the middle of many people's working days. If you were to say, where's this going? If we were to have this webinar in a year's time, Tony, what do you think the real risks are going to be to professional services firms and other vulnerable sectors, particularly given the increase in home working that we've seen in the last year?
I still think ransomware is going to continue to be a major issue, and especially with home working, it's because the home workers may not necessarily have the sort of protection systems in place that offices do, depending on how that remote working has been set up. All it takes is one unfortunate email to come through that you've clicked on by accident. I still see that. I still see that we're going to continue to see, I think, issues where personal data has been exposed. Now, either that through an attacker or just misconfiguration. We're still seeing the old S3 buckets leaks occurring, despite it being now terribly hard to actually do that. You have to do it on purpose now, really. So I still think some of these things are going to still be there in a year's time. And I think what we will have is that more organizations will be publicizing it because of the regulatory requirements on disclosure. Whereas I think a couple of years ago, you didn't hear much about it. I think but it occurred because there was no requirement to disclose.
Well, look, that's an extremely interesting forecast. This is a recorded webinar. We may hold you to it in due course if we can gather again in the year's time. On behalf of all the panel, wish to thank you all for taking the time out of your day. You've been good enough to stay with us, I see, for the duration. And as I say, thanks again, and I hope you have a very productive day. Bye-bye.